Schwab just confirmed what the data has been screaming for months. Retail traders aren't just dabbling in options anymore. They're flooding in at rates we've never seen before, and Wall Street is quietly panicking. Stick with me for the next 7 minutes because I'm going to show you exactly why this shift is happening, what it means for markets, and how you can position yourself before the crowd figures out what's really going on. Let's get into it. Schwab's latest trading data reveals something stunning. Options adoption among retail investors has hit record levels. We're not talking small bumps. We're talking a fundamental restructuring of who controls leverage in American markets. Think about that. For decades, options were the exclusive playground of hedge funds, market makers, and institutional traders. Complex Greeks, expensive platforms, information asymmetry, all of it designed to keep you out. Now, the gates have been blown wide open. Here's what's driving this surge. Force number 1, zero commission trading. When Schwab and others eliminated options commissions, they didn't just save traders a few bucks. They removed the single biggest psychological barrier to entry. Suddenly, trading a 10 lot doesn't feel like feeding the machine anymore. Force number 2, education accessibility. 5 years ago, learning options meant buying expensive courses or reading dense textbooks. Today, thousands of hours of free content, paper trading simulators, and communities breaking down strategies in real time. The knowledge gap is closing fast. Force number 3, and this is the one nobody talks about. Volatility addiction. After 2020, an entire generation of traders experienced what leveraged returns feel like. Going back to 8% annual gains feels like watching paint dry. Options offer that amplified exposure people now crave. But here's where I need to hit you with some reality. Because this adoption surge has a dark side that Schwab's press release conveniently ignores. Studies consistently show that between 70 and 90% of retail options traders lose money. Not break even. Lose. The leverage that makes options attractive is the same leverage that vaporizes accounts in days. I've seen it happen. Traders who made $20,000 in a week felt invincible, then gave back $50,000 the next month. The options market doesn't care about your feelings. It's a zero-sum arena where every dollar you make comes from someone else's pocket. And here's the pattern interrupt you need to hear. When retail floods into any instrument, smart money adapts. Market makers are adjusting their models. Hedge funds are developing new strategies specifically designed to profit from predictable retail behavior. That meme stock options flow everyone celebrates. It's being tracked, analyzed, and traded against in real time. This isn't conspiracy, it's just math. So what does the smart retail trader do with this information? First, recognize that increased adoption means increased competition. The easy money trades from 2020 and 2021, they're gone. You're now competing against millions of other retail traders, plus algorithms that process information faster than you can blink. Second, understand that options should be tools, not lottery tickets. The most successful retail options traders I know use them for income generation, hedging existing positions, and strategic leverage, not YOLO plays hoping for 10 baggers. Third, and this is critical, position sizing will determine whether you survive this market. The traders blowing up their accounts aren't wrong about direction 50% more than survivors. They're just betting too big, too often. Let me give you the framework that actually works. Never risk more than 2 to 5% of your portfolio on a single options trade. Yes, this means smaller gains. It also means you'll still be trading next year while others are posting loss porn and starting over. Use defined risk strategies. Spreads, iron condors, covered positions. These limit your downside while still capturing the leverage benefits that drew you to options in the first place. And track everything. Your win rate, average gain, average loss, biggest drawdowns. The traders who treat this like a business, with actual metrics and accountability, are the ones who make it. Now here's what happens next. Schwab and other brokerages will continue promoting options trading. Why? Because it's incredibly profitable for them. More trades mean more payment for order flow, more margin interest, more engaged users. They want you trading more, not trading better. That's why you need to be intentional about your education. Learn the mechanics before you risk real capital. Paper trade until you're bored. then paper trade some more. The opportunity here is real. Retail traders who develop genuine edge, who understand volatility pricing, who read flow data correctly, who manage risk religiously, they can absolutely compete. But they're the minority. Don't be average. Average gets destroyed. If this breakdown helped you see the options market more clearly, subscribe and hit the notification bell. Every week, I bring you the data and analysis that separates informed traders from the crowd. Your financial future is worth 7 minutes a week. I'll see you in the next one.